So how do you analyze a deal? You got to ask yourself, whoa, is this even a good deal? So when it comes to appraisals, there's paid appraisals, there's CMAs, there are BPOs, which is a broker price opinion. All of these cost money unless that real estate investor themselves is running the CMA. I'll be honest, that's what we do for our lenders. And a lot of them don't even ask for it. I guess just because of trust or whatever. But that's how we analyze all our deals. We do an in-office CMA, comparative market analysis, finding similar and like type properties that have sold recently. So we provide that data to our lenders. You may want to order an appraisal. They also have a cheaper version called a desktop appraisal, which in my experience, those are fine. BPO is probably the cheapest option that you can get here. And you need to talk to your borrower if you are requiring an appraisal, if that's something that you're going to pay for or if the borrower is going to pay for. I will tell you that we essentially pay for everything whenever someone's lending to us, except for appraisals typically, because we do such cookie cutter type of deals. So that's not something that's actually even routine, but I guess we'd be open to paying for that on a case by case basis, but that's just a conversation that you need to have with the potential borrower who's going to pay for that. You want to use proven numbers. Okay. So this is a very, very, just a pretty typical formula to analyzing a deal. I apologize, there's a typo on here. It says example 75% LTV. This is example 70% LTV. We were in a market where we were doing a lot of 75% deals. I adjusted this last week and forgot to hit that part of it. Because what we are doing now is we're moving into a recessionary period, right? We're moving into theoretically, a downturn in the market, whether it's short term or long term. So whenever we move into a market like this, we're looking for bigger, deeper discounts on ourselves, for ourselves to safeguard ourselves on our deals. So, for example, the way that I can explain this is if a real estate investor was buying a property, buying a house that was going to be worth $100,000 after all the repairs were done, and if they bought it and fixed it up, then if I was, coaching a real estate investor to buy it, I would tell them that their loan amount would be 70% of that $100,000 minus the repairs. So on this particular deal, if it was a 70% ARV, that would mean $70,000 minus the repair cost, okay, which would be $25,000. So then that means that the real estate investor's offer is going to be about $50,000. And that's pretty typical, is that we buy houses for about 50% or 50 cents on the dollar before the repairs. So then that real estate investor would buy it for that $50,000, use $20,000 or $25,000, whatever you loan to them, to do the repairs, so that they could turn around and sell that property for $100,000. So basically, what I'm really wanting to drive home the point. I know it says that my math is all wrong on this slide, so I apologize. This should really be basically a $45,000 maximum offer if those repair costs were $25,000. But long story short, this should be about a $70,000 loan amount to put you at a 70% LTV. If you're comfortable in the deal at a 75% LTV, then it could be a $75,000 loan amount. But what I don't want to get lost in maybe a little bit of confusion on the slide is that 25 to 30, 35% equity in a deal, that's your oxygen as a lender in the event that borrower doesn't perform for some reason. So you got to have that equity. In my opinion, we've done a lot of 75% deals. We've done a lot of them in certain markets, and they're typically are very cookie cutter vanilla low risk, very light rehab, short days on the market, single family homes. But in today's market, we're moving towards looking for 70% ARV deals. So always make sure you have an equity position that's good for you. Rehab costs, you need to ask yourself if you're going to go off that investor's word or if you're going to make them provide rehab estimates. And then, of course, I've already kind of mentioned it, but always verify and understand what you're investing in. All right. So when it comes to analyzing, this is kind of going back to analyzing the borrower, but also combined with analyzing the deal. What's the loan to value? We just talked about that. What is the experience of the borrower, the background of the borrower, the financials of the borrower? Do they have skin in the game? Is this a big rehab or small rehab? Typically, less rehab equals less risk. Big rehab, more additional risk. What's the draw schedule? Meaning, are you loaning all that rehab money up front to the borrower, or is there a draw schedule? Obviously, there's more security if there's a draw schedule in place for you to only release rehab money as rehab work is done. What's the risk of the deal? Typically, fix and flip deals are seen as higher risk than a rental property. What's the condition of the market? Meaning the overall market, and you look at today's day and world where, it's craziness. It's absolute craziness. But we've got, everything negative that I've mentioned with the stock market, oil and gas, unemployment, COVID-19 pandemic, got a lot of negative things. But we also have, in a lot of markets, a very beneficial supply and demand type of stats on the housing market, as well as very low interest rates. So what's the market like? The overall market of the economy of the U.S. and the market of that city, and the sub-market, meaning that specific neighborhood or that subdivision, right? Because even in the worst of times, I've seen some subdivisions that really stay very strong. And what's your gut test like? What do you feel about this particular deal, about this particular borrower? Whenever we're doing a deal, we run everything through a formula, a buy formula, an analyzer formula, where we analyze it as a flip deal, as a rental deal, as an owner finance deal, or as a wholesale deal, and we look at the numbers and run it through the numbers. We always go with our gut, right? It's like, all right, we're going to move forward on this, or we're not. And sometimes it just comes down to that gut test. And so that's what you need to do. So how do you secure a deal? So here's some items that you should absolutely look at requiring if you're going to be a private mortgage lender on a deal. So we send everything, like I mentioned, to a real estate attorney. That attorney is going to provide a note, a deed of trust. And if you want me to send you a copy of our loan documents, you can absolutely just reach out to me and I can send you a copy of one of our loan document packages. I always provide a personal guarantee. I've heard some real estate investors like, I'm giving them a secured asset with equity in it. I'm not going to also personal guarantee it. I always personal guarantee my deals. I've done hundreds of these things and I've always performed, so I'm not worried about that. And why wouldn't I do it? Like anything that gives my lenders peace of mind, I would do that. So if you have a borrower who doesn't want to give a personal guarantee, you may just want to ask that question, why? Absolutely. Title, company closings, survey. Okay, so I understand that you may be in a different state, and some of these structures may be a little bit different, note, mortgage, title companies, and things like that. But here in the Texas market, this is the structure that we have, so I do want to say that. We always have title company closings. We provide a survey. We pay for and provide a survey. We pay for and provide title commitment, title insurance, property insurance, clearly defined escrow terms. That's getting to escrow if repair monies are released up front or based on a draw schedule. And then also just making sure that you have a working knowledge and understanding of the terms and the structure of the deal is critically important.